Today, we will, of course, cover the FOMC event that just went down. I'm not going to give you the most basic stuff, the fact that the Fed just cut 25 basis points as expected, like we have been mentioning for the past 2 to 3 weeks. The most likely outcome, the 98% scenario, turned out to be true. Great. What I really want to dive into today is why this is not a one-time sell the news event. Instead, it means we're going to get more rate cuts, at least over the next 2 FOMC meetings, which are in October and December. I was sitting on the Jerome Powell Q&A session for the whole period, and I was doing a ton of research on specifically the dot plots of the Federal Reserve governor's projections, and those have significantly changed for their targeted federal funds rates by the end of this year. I think that's the most immediate takeaway that we can get, which is a dovish, bullish pivot from the Fed. This is what's really important from this meeting. So we'll dive pretty deep into that, but I'll try to simplify it for you guys as much as possible. And of course, we'll look at markets, but TLDR, this is actually very bullish. It's not a one-time sell the news event. Okay, let's get right into it. So the main gist of today's event was that the Fed cut 25 basis points. Okay, this is the first time that the Fed has cut rates since December 2024. So 10 months already. Okay, so you see this is the last time they've cut, and it has remained at this level until this morning. And I took snapshots of the probabilities before this event has happened, right around 1 p.m. And the probability of the rate cut going into this meeting was already, albeit confirmed. Here is the comparison with before this meeting. You see right here. So before, people were already pricing in 94.97% chance. So this wasn't a mystery. And that's why it's not causing really any market movements, because unless they do some unthinkable, such as doing a double cut with 5% probability, or not cutting, like this one right here, which was literally 0%, unless they do one of those two really rare choices, the market was not going to be bullish or bearish immediately. And this is what we're seeing. The market is not moving. So now a lot of people are saying, oh, this is sell the news event because nothing has happened. It's already priced in. I disagree, because something else that gets released every quarter is the dot plots, which is the projected federal funds rate, the interest rate target by end of this year and next year. And this is what's really important. I recommend you guys to go check out this full, press conference from Jerome Powell. And in here, many of the questions are surrounding SEP, or Summary of Economic Projections. This is what it stands for. So TLDR here is every quarter, you will see one of these projection materials coming from the Fed's meeting. And in here, it will outline what the Fed governor's projected interest rate target to be by end of the current year and end of next year, and end of the 2 years, and then after. And this is really important because this number has changed that we didn't get before any of this probability stuff from the markets. So take a look at this. In the June FOMC meeting right here, this projection material is this one right here, June 2025. And when people say dot plot, the plot they mean is this. So how do you read this, right? How the Fed works is that the FOMC, the Federal Open Market Committee, this is literally a group of economists. I don't know how many of them is here, like 15 or so. Anyways, how the targeted federal funds rate, interest rate works is literally these people sit down and they vote on what they want the rates to be, meeting after meeting. And then they give these dot plots based on all the material, based on unemployment and inflation data to say, okay, do we want to raise rates? Do we want to cut rates? Do we want to hold it still? And the dot plot is each participant's assessment of what they want the rate to be by a certain date. Okay, so let me move myself here. So this shows each governor's intended interest rate to be by the end of 2025, end of 2026, etc. So you see back in June, most Fed governors have voted that the rate to be just below 4%. Okay, so you can see the range right here, and if you put these ranges in numbers, these were right here in June. So the median was 3.9%, which is basically what we are at right now, between 3.75 to 4. That's what we are currently at. No, between 4 and 4.25. And we're basically there already. So this was, if this number didn't change, it would have meant that most of the Fed's projections have been met. So probably no more cuts. However, this number has changed in this meeting. So let's look at this projection material that just came out this morning. That's this one, September 17th. Same thing. What do the Fed governors vote on? Well, here is the new dot plot. And you see this has shifted down. Here is the old dot plot. And here's the new one. So you see way more of the FOMC committee members have voted for lower interest rates by the end of 2025, where we're only 2 more FOMC meetings to go. And a majority wants the rate to be closer to between 3.5 to 3.75%. And taking the median, the actual number is now 3.6. Whereas from June, we were at 3.9. This is what's really important, because this tells me, and the market, as we'll see a little bit in this CME Fed Watch tool, that we will get more rate cuts from now until the end of the year. And we will get them only in these 2 meetings, October 28th, 29th, and December 9th to 10th. How many rate cuts will we get? Well, we should at least get one more. This is what the market is pricing in at the moment. I'll show you. And the median, if we take the highest probability of what's to come, we should get 2 rate cuts. Whether that's a double cut and then a pause, or 1 cut and 1 cut in the next 2 meetings. This is dovish. This is bullish, because nobody were pricing in these things going into this meeting. Because up until this point, the Fed in this whole rate cut cycle has been meeting after meeting. They cut once and then they pause. They cut once, they pause. This is why it has always been kind of a sell the news event. But this time it has changed. So this is the dot plot. And you see, even if we take the central tendency instead of the median, which is how you take the central tendency is you exclude the outliers, the 3 outliers that are too high and the 3 outliers that are very low. You get kind of roughly what most Fed governors are expecting, and they are expecting lower ranges than what we are currently at now, which is 4 to 4.25. They want to get it down to the highest 4.1% and the lowest 3.6% by the end of the year. This is what's really cool. So if you guys want to ChatGPT this, Google it. You can Google Federal Reserve FOMC dot plot or SEP, Summary of Economic Projections. I think this is what really we need to look at for this pivot today. Okay, so the market is already trying to price this in, but most people haven't reacted yet. This is because look at the current meeting probabilities, okay? So before going into this meeting, people were pretty mixed. This is the CME probabilities that people are expecting before today's FOMC for the next rate cut, for the next FOMC meeting and the December FOMC meeting. And you see people are pretty split. 24% of people tend to think that we're not going to get another cut in October, while 72% were expecting one cut. And then you see the December one, there were 27% of analysts that expect one cut over the next two meetings. Now, these probabilities have increased, okay? Here are the current probabilities. You see, now 86% of analysts expect the next meeting to also be a cut, okay? And by the December meeting, the following meeting, 82% of people expect yet another cut. And especially when you look at combining this with the dot plots, okay, the fact that when you take the central tendency, like most Fed board members are expecting at least one more cut by the end of the year. And this is reflecting in the probabilities when you look at them in aggregate. So how you can read this is, these are the dates. Okay, we're currently at September 17th. We want to read the 2025 numbers because the dot plots, they come out every quarter. So since we are already in September, the dot plot for this quarter for 2025 is going to be the most accurate because we're not going to get that many changes over just two meetings. Whereas if you look at now, the projections to try to predict end of 2026, it's going to get very skewed. A lot of things can happen. So you want to really look at these two meeting probabilities. And what's really cool here is by the December 10th FOMC meeting, the chance that we get no more rate cuts is 0.6%. So there is not a question now that we will get one more cut at least by the end of the year. One or two. Whether we will get one or two, that's unsure. And exactly when, if we will get it in October or December, it's unsure. But because of these newly released dot plots, basically the market agrees that we will at least get one more rate cut by the end of the year, and likely to get two cuts by the end of the year. Here's the takeaway. Yeah, very bullish because of the dot plots that's just been released. So I'm not trying to, just say, dissect whatever Powell has said. This is literally data. This is coming from votes from the dot plots, and that it's actually changed. And we are so close to these 2025 end of year projections that we can make a pretty accurate call to say we will get more cuts by the end of the year. That's why this is bullish. It's not because we just cut, but it's because it's forward looking. It's because there are events that are coming up which people are not understanding fully yet. Okay. That's the most important. Now, you can look into the speech itself and what Powell has said. This is a pretty soft stance that they're taking. So the gist of it here is that the reason why they're cutting is because jobs numbers have slowed a lot. So over the last 3 months, if I can find the data for you here on one of these, where is the number? Here. We have covered this before. So over the last quarter, from May, June, July, August, all of the job numbers, new jobs being added in the US have been revised down. And not only is it for this quarter, but also the annual revision data that just came out on September 9th. Yeah, on September 9th. This is a annual, not an annual, I believe this is quarterly report that looks back at the total amount of jobs in the US from half a year ago, accounting for that 1 year. So this data is for April 2024 to March 2025. And this period, okay, is not even Trump related. Most of this period was still Biden administration. And even in that period, April 2024 to March 2025, the initial reported jobs in the US have been revised down over that 1 year by 911,000 jobs. This is another big hit to the jobs data. So this is why Jerome Powell came out today and just basically, he was very soft. He didn't say the usual like, hey, jobs numbers are great. There's no unemployment. We are combating inflation. This time, most of his speech was around inflation is still high, but it hasn't been rising that much. And on the other hand, jobs are really weak because literally the numbers have been revised down across the board. And so he's making this decision. And even when asked about the target interest rates by the end of the year, he was pretty soft as well. So here is the transcript of his entire Q&A session. And there's something that's really, really interesting that I wanted to note, which was this rate path. So this is part of what he said. He said that it starts with a 25 basis point rate cut, but the market is also pricing in a rate path. In this case, more rate cuts to come. He just says, I'm not blessing what the market is doing at all. I'm just saying it's not just one action. In this case, it's not just one action, meaning it's not just one cut. He got many of these questions, and unlike before where he has continually just said, oh, we're data dependent, we're only going to cut once, and then next time, let's see. This time he says, we're going on this rate cut cycle. He's not guaranteeing anything, but the SCPs that he continuously refers to is this dot plot. He has said many times throughout today's speech about the SCPs. Basically, this is telling me that the SCPs have changed and they want to come more. And this is a new rate cutting cycle that's beginning. Now, specifically, okay, are we going to get, a whole year of constant cuts? That's, nobody really knows. Because, right now they're really in a pickle. Unemployment is high, but also inflation is still high. So they can't really commit to too long, but at least towards the end of the year, we will get more cuts. At least one, if not two. The chance of 2 rate cuts by the end of the year is still higher than 50%. It's right now pricing in at about 80% chance. So very good times ahead till the end of the year. I think that's the most we can expect. We can't really, look at these data and say, oh, bull run till the end of 2026. Nobody should be using the data that way. Okay. That's the gist of it. That's the most important stuff. And one more, you can look at this in 2 ways. If you want a little bit more context to feel his stance for yourself compared to previous FOMC speeches. So you can just watch this Q&A session that starts at about the 1 hour mark. It went on for about 50 minutes. For every time that he was asked about how many times will they cut going forward? Is this a one-time cut versus more cuts? He has been pretty soft. And you can also look at the FOMC statement, red line. So how this works is they take the FOMC statement from their website, the HTML press release, and they compare it with the last meeting release. And they try to see what languages have been changed. So mainly, the highlight is jobs gains have slowed, unemployment rate has edged up, but remains low. But they also already said remains low last time. So you want to look at the changes. To pair with that, they have said inflation has moved up, but this is the only mention of inflation at this point. So 1, 2 mentions and 3 mentions of unemployment. Here they added, the committee is judging that downside risk to employment have risen. Okay, and then in light of the shift in the balance of risk, in this case, the balance of risk means they want to balance high employment and low inflation. And before they said that the two have been balanced, and this is why they haven't been cutting. Now they're saying there's a shift in the balance of risk, which means there's a higher risk of more unemployment, more job loss. Okay. Or slower job growth, to be more precise. And this is the change in the actual rates. There you go. So very straightforward. They have cut once. They are changing up their language to recognize that unemployment is rising while inflation is the same. So thus they need to cut. And most Fed governors are voting that by the end of the year, this is the kind of short-term number that we can look at, which is unlikely to change. By the end of the year, we will have one more cut, and we're likely to have two more cuts. That's the takeaway, and you can take that for how you will. Likely that's going to be bullish for the markets. Just a little bit on the Federal Reserve balance sheet. That hasn't been changed. So here, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, aka quantitative tightening continues, and they will continue to let the balance sheet run off. He did answer one question about balance sheet that I can point to here. So here's what he said. He was asked, since you're cutting rates, why haven't you stopped the run off the balance sheet? And he says the run off the balance sheet is very small now, the smallest it can be on a per month basis, the cap. And thus he doesn't see it as a big contributing factor to how the markets are doing, how the economy is doing. And that I agree, because since the beginning, since March, if I'm not mistaken, the runoff of the Fed's balance sheet has been capped at $5 billion per month. This is the smallest denomination that they can have. And they also put in a difference between the amount of Treasury-backed securities and mortgage-backed securities that they can sell to favor helping the Treasury market. So the Treasury part of the balance sheet holding is what contributes to liquidity, whereas the mortgage-backed securities is not as much. And there's even that, which means they can, even when they want to reduce the size of the balance sheet, they can choose to sell more mortgage-backed securities while holding more Treasury-backed securities. So this has been good. And basically, they are at a state where the only thing that they can announce for balance sheet now is a full pause. They don't want to sell anymore, but that's kind of a slap on his own wrist, because he has said before that he doesn't want to pause until rates are at 2%, which is we're nowhere close yet. So there you go. No, not rates at 2, inflation at 2%, rates at 0. But we're not able to achieve those goals anytime soon. So he's kind of saving face while having the balance sheet run off very, very slowly now, the slowest it can be. This is what he answered here today. Okay, so yeah, that's all the news that matters. Don't panic. This week is still going to be volatile because, every single FOMC event has been volatile. People try to trade way too short term because all they can look at is like this. They see, what is this? The probabilities going into the meeting. This is not updating. Yeah, the probability going into the meeting was 95% chance, one cut, 5% chance, double cut. And they want to trade that. They want to say, okay, if they get a double cut, market is going to go ballistic immediately, so I want to go long. And then, you don't really want to do that because markets can really go either way in one day. But when we look at one quarter, I think this is going to be a bullish quarter. because of the dot plots, because of the projections from today. Okay, so I'm not doing anything immediately short term. I'm just continuing to hold spot, holding Bitcoin, holding the large cap altcoins, because again, I expect Bitcoin to be higher because we're getting more cuts by the end of the year, and subsequently altcoins are going to be higher because Bitcoin is higher. And we are in alt season because Bitcoin dominance is going down, the whole shebang, you already know it. Rate cuts, they are only contributing to market expectation and what the market can see as bullish or bearish news. And today's cut, the fact that we got 25 bips just as expected of a cut, is completely irrelevant now for what's to come in the next couple of months. It basically just closes that trade that people have been looking at over the last month, that people were saying we're going to get a cut. But now we have new information that we should get 1 or 2 cuts by the end of the year. And that's a new trade. That's a new wave of speculation, which I think will drive the market up. This is the most, accurate, transparent way to look at it. It's not some magic that, 25 bips of cut somehow leads to buying in Bitcoin. You got to think of it this way. And because this news is forward looking, I do believe this will drive markets to do well over the next quarter. So my actions right now, continue to hold Bitcoin, continue to hold large cap alts. Let's see how it goes. Okay, so thank you guys for joining the live stream. 2 things, as usual, check out our trading bot tutorial. And if you want to follow my 100K trading challenge, all the links are in the description for the dashboard and the tracking for all my positions. You can also take those trades yourself. And follow me on X at VirtualBacon0x, where I'm going to be dropping day-to-day alpha as more and more people are going to be talking about this dot plot. Maybe I'll put it into a text format as well, so you guys can get a refresher on that for later this week. Okay, that's it. Thank you for watching, and I will see you on the next video and next live stream.